Okay, I'm letting them in.
Okay. Welcome, guys. We're just waiting for a few minutes, few seconds for everybody to come on and get started here in about 30 seconds or so.
Hey, Jason, how you doing?
Jason. Yeah, so we'll keep it fairly free. If you'd like to keep your camera on, by all means do that. And we're going to keep this fairly interactive. Hopefully, if you have any questions, you can speak up, raise your hand, put it in the chat.
Hey, Gary, how you doing? Thank you. Hey, Sandra, how you doing today? And,
Oh,
on mute, but you can unmute throughout if you have questions. So I think we've got a few more people that should be showing up, so we'll give it another 30 seconds.
happy Friday to everybody. You get
Indeed.
started, Todd?
Yeah, go ahead. We've got a few more people that'll be showing up, but let's go ahead and get started. Just to keep on time.
Sounds good. All right, welcome everybody. My name is Britton Williams, financial advisor, Calamita Wealth Management. Todd Calamita, founder, owner, advisor as well. We're going to be going over together what is more important about when it comes to tax season. So the Wells Fargo 2024 financial calendar for you, the employees. This is the second time that we've done this. We're going to be focused earlier in the year. In December, we did January and February. Today, we're going to look at March and April, specific around how you can save money on taxes and take better control of your taxes. So stick around. If you don't have it already, we're going to provide you with a link to the financial calendar, which encompasses the entire year with helpful, actionable steps that you can take. Again, we're going to be looking at a few on this session that aren't even on the calendar, some actions that you can take today. Our contact link is going to be in the chat. So please, if you have any questions that you don't want to go over on this call, set up a brief call with us, and we're happy to go over those specific questions. And we want to hear from you. So we want to have a more interactive discussion. We're going to pause every 10 minutes or so to allow you to ask your questions. Along the way, don't wait, put them in the chat, and we'll get to them, queue them up. So I don't want you to forget what they are. Your video's on, you can turn it off, you can speak up, raise your hand, and don't be shy. You can also type it in, and we'll go over that again every 10 minutes or so. We'll pause for questions. All right, let's move on. So March, here we are, mid-March, March 15th. It's important to know that today your paid time off and FSA benefits do expire. It's nothing you can do about today, but to plan for in the future. Most people are on top of that just because of how valuable it is. But it's an important date nonetheless. The 2023 HSA and IRA deadline is April 15th. The amounts that you can put in those respective vehicles are going to be in the chat. Todd's going to add that, but I'll say them right now. The IRA is 60 for 2023 is the maximum you can put into the traditional IRA is a Roth is 6,500 or 7,500 over the age of 50 as the catch up. And then the HSA, Todd's going to put in the family amount maximum. And Todd, what's that maximum for the family amount?
Yeah, so I put that in there. So for family for HSA, 7,750 for last year. And then you were asking for this year? Sorry.
Yeah. Okay. Well, now you brought up for 2024, what's the maximum for HSA?
Or
Health savings accounts.
yeah, so it'll be 8,300 for family. I'll drop that in there too. So,
Okay.
but again, you have until April 15th to put in for last year. So if you haven't done that, be sure to put that in there.
Sounds good. And the IRA for 2024 bumped up from 6,500 to 7,000 and 8,000 respectively for the catch up for 2024. All right, so let's talk about there were 3 retirement buckets, quote unquote. Are you funding these 3 retirement buckets? And I kind of got asked the audience here, like, first of all, what are they? Does anybody know what 3 types of retirement accounts that we're talking about?
401k, IRA. Not sure what the third might be for you.
Okay, anyone else?
It could be Roth and non-Roth IRAs, right?
Right.
Okay.
Yes. And it's going to be like, because the 401k and IRA, you're going to have the pre-tax and the Roth options both. So think of it as separate, like from a tax perspective, you got the pre-tax, the Roth, and the taxable. So those 3. And the before tax, like the traditional 401k, why would you do that? It's to reduce taxes today. You get that tax deduction of the dollars, lowering your taxable income today. With the Roth, you reduce taxes in retirement. You're going to pay tax on the money going in, but it's going to grow tax-free. You never pay tax on that money again. And then the taxable account is to fund early retirement options, but really it's to fund retirement options in general to lower taxes. And we're going to talk about some strategies around why that taxable account is important to fund as well. It's one of the more neglected ones because, well, you have these 2 above it available to you with the 401k, and a lot of people are aware of like the IRA and the Roth IRA.
Is your taxable bucket your traditional brokerage type account?
Exactly.
Okay.
I was going to say it's also referred to as the individual brokerage account, joint brokerage account if you have a spouse on there. Even a trust account is going to be, again, a taxable investment account. But it's it's referred to as a kind of a non-retirement account, but really it can, because you can pull money out at any time without any penalty. As comparatively speaking, with the other 2, there are you have that 59.5 limit when you can start taking money out. And so just for example, on the taxable account, if you were, I got a client who worked at Wells, wanted to retire at 55 or 50, he was like 54 at the time, and he had quite a bit saved up in from the RSUs over time, RSRs as you call them at the Wells Fargo, restricted shares, and so that's going to provide that early retirement income for him, so he doesn't, because he or she can't take money out of that 401k where most of his account value was available. But even in retirement, let's say you are old enough to take money out, if you can finance, quote unquote, your way to taking Social Security, may be advantageous to do so, and taking money out of the taxable account to live off of might be a good strategy. As well as doing some Roth conversions, which we'll talk about in a little bit. Anything to add here, Todd?
The only thing I'll mention is that the taxable account, or as Gary had said, that just a traditional brokerage account, it's either going to be the gains on that account will either be taxed at 0%, 15%, or 20%. So there is some planning you could do around that, so that ideally you take the gains out at 0%. We won't get into details on that, but just be aware that's how a taxable account is, the three, three tax tiers on those.
Okay, so now we're going to talk about just what do you have available to you. It's specific to Wells Fargo, the 401k. You've got the before tax and the Roth. I'm going to hand it over to Todd to talk about this section.
Yeah, so this is probably one of the most common questions we get regarding the Wells Fargo 401k. Should I put the money in before tax or traditional or Roth? And we got two kind of diagrams here to help, just to kind of help you visually see which one is the better, just from a math perspective. We'll talk about maybe some other reasons you would do something a little different, but in general, at the top image there, you can see the current marginal tax rate on the left there. If it's higher now, so you would, from a math perspective, you'd put it in pre-tax. So you get the tax deduction now, and then you could see if you go down, kind of down that seesaw to the right, the future tax bracket is lower. So you're taking it out in a lower tax bracket. So for example, you're getting taxed maybe at the 22% tax bracket in the beginning when you get the tax deduction, but it's coming out in, say, the 12%. Conversely, if you look at maybe when to contribute to the Roth, the bottom image there, let's say you're earlier in your career, for some reason your income is lower in a particular year, you would put it into the Roth. So if you're at a lower marginal tax rate today, you'd pay the taxes now, and then it's going to grow tax-free. So then it's taken out in a future bracket that's higher. So that's a kind of the most simplest way to look at it. There's other reasons you would do one or the other, but just from a simplest perspective, that's what you want to look at. That's kind of the easiest way to make a decision. And I think if you go to the next slide, Britton, I want to talk about how you do that mechanically. You're probably all familiar. You log into your Wells Fargo 401k at.
Can I ask you a question? I hate to interrupt. No, on the previous slide, how do we know what those tax numbers are with current state versus future state to do the math?
It's a good question. Yeah, well, two things. A couple slides ahead, I'm going to talk a little bit about looking at your tax return to see where you're at now.
Mm-hmm.
Yeah.
There are some projections you have to do. What I was also going to add is that you don't always know. So you don't always know, but we can make some educated guesses. If you're in a very high tax bracket now, and you don't foresee, any type of continual income in retirement that would match what you're making on your salary, then you might say, okay, you're going to be in a lower tax bracket. Now, if the tax brackets are pretty low, let's say you're in the 24, and maybe you're going to drop to the 22, it's a little bit harder to predict. But you really have to do some tax projections. So you have to have some tax projecting software, which, obviously we would have access to that. One of the big things that's somewhat overlooked are your required minimum distributions. So people don't realize maybe how much actually has to come out of there. So sometimes that comes into play. So you want to kind of project that. You also want to look at your pension if you have one, and then obviously Social Security. So it's a good question, but it's not super simple to necessarily know that. And that's one of the reasons, if we look at that next slide again, Britton, you do have these, some people aren't aware, but there's actually three options in there. So you do the before tax, you click there. If you want to do the Roth, you select there, and then there's this split your contribution. And this, I think, talks to what you're saying, Garrett. You may not know, right? You may not exactly know. So you can always split the contribution. If you click on that and hit continue, you could say do 10% before tax and maybe 5% after, just to kind of hedge that. And we always say it is nice to have a little bit of each of those three buckets in retirement, so you do have choices. So you want to have some flexibility. And there are times where maybe you're in a high tax bracket now, we might say put a little bit in the Roth. So, there's kind of a science to this, and there's a little bit of an art to it. And that's probably what you're getting to, Gary, also.
Yeah. And your traditional IRA goes into the third bucket, right? Your brokerage bucket.
The traditional IRA, that would actually be, so make sure I'm answering the right
Back
question.
here.
Yes,
Yeah, exactly.
Yeah, that's actually a before tax. So the traditional IRA is just like the traditional 401k.
Oh, it is.
Yeah, so we could go through it real quick. So the before tax accounts you may be familiar with would be the traditional 401k,
Mhm.
Traditional IRA, SEP IRA, simple IRA, and then the Roth would be the Roth IRA, Roth 401k. And then going back up, if you had a solo 401k, if you had an individual, that's both of you are going to have access to the traditional 401k and then a traditional IRA. That's going to be the first bucket.
so it's often held at a brokerage firm, Gary, but it's a little nuance between the taxable account and the
Yeah.
IRA account is going to have that maximum, 7,000 this year, or 8,000 if you're over 50.
Okay.
Yeah, maybe some semantics here too. Like brokerage accounts typically would be referred to that as the taxable account, individual account, or joint account. But I have heard people refer to their IRA as a brokerage account. It's at a brokerage firm. So it's
Yeah.
makes sense.
I think we can move, again, the mechanics, of this. The only other thing I'll mention on that slide before is if, as we mentioned earlier, the 401k limits have gone up for 2024, so they're 23,000, and if you're over 50, you can add an extra 7,500. So if you're not on track, to max it out, here's where you would go to make those adjustments as well, so that you're not stuck in December falling short of, maxing it out.
All right, so we're going to pause for questions here. We've covered a couple already. Feel free to speak up, throw it in the chat, or raise your hand.
Hi, this is Craig Willoughby. I have a quick question.
Craig?
Sure.
Hi, I can only stay for the first 30 minutes, and thank you all for conducting this call. I was just wondering, will the materials be available for post review after the meeting?
Yes, we'll send out a video recording, and we'll make sure you get the financial calendar as well. If you want to put your email address in there, I'll make sure that, I get it to you directly, Craig.
Okay, thank you.
About the video too.
Sure.
Anyone else? Again, we want to make this as beneficial to you. This is really about your questions today. We could talk for a while here, but we do want to hear, what's on your mind and what your challenges are around taxes.
Yeah, no dumb question. There is no dumb question, I mean. All questions.
Does it make sense as we get closer to retirement? And I'm not that far off. I'll be 60 this year. I'll either retire this year, next year, not too distant future, to reduce my 401k contribution so I have so I can start funding my cash accounts more, or is that impactful from a tax perspective?
Well, let me just say the one thing that, we do have to be careful about from, you all work at a bank, so there's regulations, so
Yeah.
we can't give you like direct advice here. I think you can appreciate that.
Yeah.
And it's a little bit of a bigger picture question too, so it would be tough to answer that question regardless without kind of understanding what sources of income you have, how much you'll need to be pulling to live off of, thinking about when you'd start Social Security. I will say, and again, typically, starting as early as you can, funding that taxable bucket is helpful. But at the same time, you may not want to give up that tax deduction right now. So I might try to fine line here, because again,
Yeah, totally get it.
but like, I appreciate the question, and we can always take it offline as well, maybe.
Okay.
Do a brief conversation offline, so feel free to contact us as well that way.
Got it.
Okay.
I have a question for you as well.
Yeah,
Go ahead.
Jason.
In general, if we've had, we're into our second career now, and our first career had a TSP account. is there anything that says we have to merge the accounts, like our 401k and our TSP, or can we let those ride separate?
Yeah, you can, let me make sure I understand. Are you saying, do you have to merge them in the future after you retire, or do you have to merge them now? Is that what you're saying, or?
Yeah, just present day. Do we have to merge? It would be basically two different types of 401ks. Do we have to merge those at present day? I realize that, once you become retirement age, there'll be some things that have to happen, but present day.
Yeah, you don't have to. I mean, and I want to just caution, because there are some nuances to the TSP, the thrift savings plan, that we don't work with those every day. So I want to be careful that I'm not speaking kind of out of line there. But some people do like combining, and I'm going to say different 401ks from different companies.
Yeah.
To have more control over it. Either to their new 401k or to like a brokerage account that maybe has a wider selection of investment options. So a lot of times it's to have a little bit more control over it.
Okay, that makes sense.
Yeah.
But we would do like a suitability of like what the pros and cons are of doing it.
Sure.
Or keeping it, like combining it, rolling it over, or keeping it there.
Okay.
That's what are the investment options? What are the fees?
Yeah.
Like the control of it, access to it. Are there any other limitations? So good question though. All right, I'm gonna hand the next section over to Todd. Again, we're gonna go over some detail here that you may not be familiar with, so we will have an opportunity to go over some questions in a couple of minutes as well.
Yeah, so I'm gonna put a question out there for the group. We make over 240,000. How do I contribute to a Roth IRA? So this is a kind of a common question. A lot of people say, hey, I can't contribute to a Roth anymore. So, a lot of times the solution is a backdoor Roth IRA. I'll kind of pose this to you all because it's somewhat of a lesser known strategy. Has anyone even heard of the backdoor Roth IRA? And you can type in yes if you have. Anyone heard of the backdoor Roth? No. Okay. So I just kind of wanted to get an idea of familiarity with it. I'm going to kind of take you through a 5-step process of how to contribute to a backdoor Roth IRA, why to do it also. So as I mentioned earlier, a lot of people are not eligible to contribute to a Roth IRA, and there's that tax benefit. We talked about it. We talked about previously that you get in retirement. So a lot of people are anxious to put money into a Roth IRA. So how do you do it if you're over that limit? Step one is you simply contribute to a traditional IRA, which we talked about earlier. Oftentimes, one of the mistakes we see is that people do not contribute to a traditional IRA because they do not get that tax deduction up front because their income is over the limit. Well, that's oftentimes a mistake because simply by contributing to a traditional IRA, you not only get a tax deduction, but the second piece of it is that money grows tax deferred. So this is potentially what you're missing out on by not contributing to a traditional IRA. It's tax deferred. You don't pay taxes on the dividends, interest, or capital gains while it grows. And there is a big benefit to that if you think about tax consequences year over year. So I'd encourage you to contribute to a traditional IRA if you have the funds to do it. The next step in this backdoor Roth IRA process is you simply work with your advisor or brokerage firm. It's paperwork you fill out, and they'll just electronically move the money from the traditional IRA to the Roth IRA. And here you go. You were over 240, but you're able to get that money into the Roth. Let's say you do that. We have some clients that have been doing that for 10, 15 years. They might have $150,000, $200,000 in the Roth IRA that is now tax-free to them at retirement. And otherwise, if they did not do this strategy, they would have maybe simply stopped at step one or didn't even contribute to the traditional IRA. Now, step 3 is important. There's a caution there because if you have a balance already in an IRA account and you attempt to do this, it may not be as effective, because what will happen is if you already have money in there and you try to move some of that money into the Roth, most of it will be taxed. So the concept of when you do the backdoor Roth is you do not want the money to be taxed when you put it in, you don't want it to be taxed when you move it to the Roth, and you don't want it to be taxed when it's taken out. So without getting in detail about pro rata, if you have money in a Roth, in an IRA already, you may want to, get additionally some further guidance on whether or not it makes sense. But just as a rule, I'd say probably don't do it. The next step is to fill out the Form 8606. This is simply a tax form. I only mention it because sometimes we've seen CPAs or individuals forget to fill it out. If you forget to fill it out, you're either unnecessarily taxed now this year, or you're unnecessarily taxed in the future. So just make sure this form's filled out if you do the backdoor Roth. And then step 5, repeat this year in and year out so that you can get the most tax advantage, most tax benefit over time. So like I said, these can accumulate, $100,000 to $200,000 into the Roth if you do this over a period of time. So I'll stop there. Britt, did I miss anything on that? Anything to add? Or do you
Just
want
to clarify, when we say we make over 200, that's the household income, that's combined adjusted gross income estimates. There are limits to what you can contribute directly to the Roth, and there's actually a phase out, so you can look that up. But we're using kind of like a conservative number there. And then when you say IRA, Todd, I want to make sure it's like the traditional IRA. If you have a balance in the traditional IRA, it's not advantageous to do it, not the Roth IRA.
Right.
All right, we're gonna move on. Again, we'll get to questions and answers in a second. This next section, I'm going to cover just general Roth conversions, considerations, strategies to reduce those required minimum distributions in the future, those RMDs as they're called. And so when you turn the age of, let's say 73, again, that number when you have those RMDs does depend on your birth date, but most of you is probably around 73 years old. If you do convert a traditional IRA to a Roth, in other words, get that money out of the pre-tax account early and put it into a tax-free growth account like a Roth, you're not going to have RMDs in the future on those dollars. So it's an example I share of a client who had she worked at Wells, and she's got roughly 500,000 in a pre-tax account and 500,000 in a taxable account. So she was living off of that amount of money in the taxable account. And she dropped from the 24% tax bracket to the lowest one, 10% tax bracket. She was living off of the taxable investment account, and because she was in a lowest tax bracket in early retirement, we did a Roth conversion analysis and saw that she could convert up to like $70,000 to the Roth in this year alone, and not and keep her inside the 12% bracket, in a lower inside the 12% bracket. And so that's going to be just an example of when to do it, but also by taking the money out of that IRA, it went from more or less 500,000 down to 430,000. Those dollars will not be forced out in the future. And in the future, based on our forecast, she's going to be in a higher tax bracket because she's then going to be taking Social Security, then going to be taking pension. And so those additional income streams are going to kick her into these higher brackets. Todd, you got an example of a client as well.
Yeah, just to kind of put some more like hard dollars on how big of an impact this can have over time. So this is one particular client that retired from Wells Fargo, I think maybe 7 years ago now. And we calculated that they were going to be in the 12% bracket, and we've been taking $50,000 per year from their traditional IRA and converting it to the Roth IRA. So and the strategy is over 10 years, because that'll be before they take requirement of distributions and Social Security, which will push them into a higher tax bracket. So we're going to take $500,000 total over 10 years, and we're going to convert that to a Roth in the 12% bracket. So if you go back to that kind of seesaw example about when to contribute to the Roth, well, they're going to be in a 12% bracket now. When the required minimum distributions start and Social Security starts, are going to be in the 22% bracket. So we've taken $500,000 out of the 12% bracket. The difference between 12% and 22%, that's 10%. So we're saving them 10% in taxes. So 10% of 500,000 would be $50,000 in taxes that's been saved over time. So again, the more time you have to do these strategies, the more you're going to save. But it's real dollars when you're talking about that type of tax savings.
And the RMD is roughly 3%. The way like it's calculated is based on your life expectancy table, the actuarial table, but it's roughly comes out to like 3% of the account value at that time. And it continues to typically increase because the way it's calculated is the IRS wants to get more and more of its money.
Yeah, it'll increase by about 1% roughly as you get older. So, that can go up substantially if you think about it.
All right, so we've covered somewhat of a lot of the details. Some of it sounds like it's going to be fairly new to you. If you have any questions, please share them now or put them in the chat.
Yeah, so again, we're getting into, these are, and I don't want to say complex, I mean, but they are kind of more advanced tax strategies. So we want to, our goal is to educate you on these so you can at least be thinking about options. So may not all be sinking in right now, but at least backdoor Roth IRA, that's a strategy. Roth conversion when I retire, that's a strategy. So again, questions you have on that, put it in the chat or unmute and we'd be happy to talk about it. Anything that maybe isn't making sense.
Is the general theme here that we should maximize in the sequence of the buckets that you guys had up on the screen earlier, right? Your 401k, and I know there should be some reasonable split between 401k and a Roth, but fully fund those two before you go into a taxable bracket. Is that what I'm hearing so far?
Yeah, I mean, it's a good question. I mean, from a tax perspective, yeah, you're getting that tax deduction with the pre-tax. I mean, we like to say there's a balance, right? For some of the reasons we're talking about, some of these strategies we're talking about, it's nice to have that taxable bucket. The taxable bucket is also good to have as an emergency bucket too. A lot of times what we'll see is that people will build up more than the sufficient amount in their quote emergency bucket, but then it's just sitting in, say, a bank account earning nothing. So there's a point where a lot of people will get to where they have more in the emergency account that they need, and it can really be shifted over to a taxable brokerage account and maybe be invested, conservatively or aggressively, depending on that particular person's situation. So yeah, we'd like to get to a balance, but again, there's only so much kind of dollars to go around.
Yeah.
But if your goal is to save as much in taxes, getting that money into the pre-tax, if you're in a higher tax bracket now, is usually the kind of the first bucket to hit. But certainly encourage a emergency fund because we all know emergencies are going to come up. So you're going to be funding a taxable account regardless. It's just a matter of how you invest that.
Whether it's Apple or a savings account that's earning close to 4.5, 4.6% these days, which is not bad, right? That's not long term, but it's happening right now, right?
That's been nice for sure. So we're at least able to get a little bit of return on that emergency bucket.
Yeah. Thanks, Todd.
You're welcome. What else? What else is on your mind?
We're going to get into the next month of April and jump right into a really cool strategy to take more control, a simple strategy to take more control of your taxes by calculating your effective tax rate and adjusting Wells Fargo pay stub withholdings. I'm going to hand it over to Todd, and he's going to take it from here.
Yeah, so again, we want to kind of put the control back into your hands. Many of you have probably either just completed your tax return or you're getting ready to complete it. If you have it in hand, if you have it handy, pull it out, because we're gonna refer to a couple line items here that I think are important. When you're doing taxes, or when you get your tax return back, it's looking historically, right? So you're looking at what happened, in this case, what happened in 2023, and for the most part, there's nothing you could do about it. So what we want you to do is kind of learn to take that information you have and apply it to the current year. What do you do with it? So the first thing you want to kind of understand is, well, what are you paying in taxes? So there's a few line items you want to look at. So this is just a snapshot of a 1040. It probably looks familiar to you. Line 15 is what I want you to focus in on. That's taxable income. So in this example, taxable income was 400,000. So that's after your deductions. That's what the government's actually taxing you on that amount. So 400,000 there. And then if you go to line 24, what's your total tax? So this is a total tax you're paid, not what's being withheld, but actually what you are going to owe. You might have withheld a little bit more, a little bit less than this, but this is the total amount that you're going to pay in taxes on that 400,000. If we do some simple math, you take 80,000 divided by 400,000, that gives you 20%. So that's often referred to as your effective tax rate or your average tax rate. So it's just kind of a shortcut to figure out every dollar that you receive on average, what are you paying in taxes on that? So in this example, it's 20%. So now what do you do with that? I think you can go to the next slide, and you can see this is a snapshot of a Wells Fargo pay stub. So it probably looks familiar. And what you want to do is you want to look at this and say, okay, I want you to focus on the year-to-date amount. So in this case, it was a $25,000 regular pay plus the bonus. So 75,000 as this example. So that was the salary or the income. And if you look at go down to your federal withholding line item, in this example, there was 11,250 withheld in taxes. So who can help me with kind of some math here to figure out the rate that you're withholding on your salary? So you're going to take 11,250 divided by 75,000. Anyone can help me out here? Where does that get us as a percentage of taxes being withheld?
You're on mute, Jason.
6?
1.5. Yeah, correct.
Oh, it's 15%? Is that what it is?
Yeah, 15%.
Okay, thank you. So 15%. So what do we do with that? So in this example, you're withholding about 15% from your pay stub. But if we look at that previous example, you owe about 20% on every dollar. So you're going to fall short here. And again, we're kind of doing a rough estimate here. So this is not exact tax advice. This is just to kind of help you understand where to look to understand what withholding you're having on your tax return. So 15% versus 20, you're going to be short. So now what do you do? So if we go to the next page here, Britton.
Yep.
So there's going to be about a 5% difference in withholding. So this probably looks familiar to you, a snapshot of the Wells Fargo workday. You have this button down here called pay, and that's going to take you to this page on the right where you have federal elections. And most people aren't familiar with this extra withholding amount, which is what I want to focus on. So a lot of people might understand, hey, I'm paying too much in taxes, but I don't really know how to adjust that. So one of the easiest ways is to go into your extra withholding. And if you're falling short on what you owe, you can calculate what that difference is between 20% and 15%. And then have Wells Fargo withhold an extra amount, in this case, $950 per pay period, to hopefully get you caught up to where you should be. So if you do that adjustment, what you want to make sure is throughout the year, you go back, you look at your pay stub, and you do that calculation to see, okay, am I closer to 20% now? And again, there's going to be some other deductions on your tax return, so this is not going to be exact, but I just want to get you in the ballpark so you know where to look, you know where to make changes to it. Any questions? What questions you have on that?
I really appreciate that advice. I've never gotten that advice before, and I've standardly added an extra $100 of withholding and still had to pay the piper every tax season because I wasn't measuring a specific metric. I was just throwing extra money in and missing. So
Mhm.
this is gonna help a lot for next year, 24.
Good, good. And the one thing, and I'm glad you asked it, the one thing I forgot to mention is that, you want to do this for, if your spouse is working as well, you want to do this on their paycheck as well, because sometimes what we'll find is that, one spouse may be withholding at 20% in this example, and the other spouse is only withholding at 10. So you're still falling up short when you do your taxes. So you want to be doing this exercise with both of your pay stubs. Ideally, you're going to be taxed, every dollar is going to be taxed at the same average rate based on your total income. So sometimes there's reasons not to do it, but typically we like to see both spouses withholding about the same percentage on both of their pay stubs. It just simplifies it.
But when and if you're also making investment income, that taxable income bucket over there,
Yep.
you gotta factor in that money that's not getting taxed.
Mhm. Yeah, another good point, and that's what I said, this is kind of a little bit of a back of the napkin, but it tells you where to look. And it also is assuming that your 2023 income is gonna look pretty similar to 2024. So, if you get tossed in another tax bracket, or you have some restricted shares hitting in a certain year, that could change. If you have, more investment income, it could shift it, but again, we're not giving you advice, we're giving you a little bit of education on kind of where to look and how to do that math for yourself.
Two quick things. I appreciate it as well, as Jason was mentioning there. So for that $950 withholding additional amount that you showed, would it not be prudent to put that into that high yielding savings account over the course of the year, get that 4%, and then pay your taxes at the end of the year with that potentially? And then when Jason just mentioned, or you have to factor in your taxable accounts, we don't have to worry about the taxable accounts until we withdraw from those accounts, correct?
Okay, well, let me answer your first question first. And so this is kind of a preference. So you don't want to get into a spot maybe where you're paying a penalty
Yeah,
at the end of the year. But a lot of people like to say, hey, I'm going to hold on to that money for the reasons you're saying, earn a little interest on it, and then pay a tax bill at the end. I think part of what we want to do is make sure that nobody has this, that they're surprised and they owe and they don't have the money set aside. So
right.
it's kind of up to you if you want to. Some people feel more comfortable just paying along the way and they don't owe anything because maybe they're not, they don't feel like they have the discipline to set that aside. But if you do and you feel like, okay, I want to earn 4 or 5% on it, well, these days you are able to get that compared to just a couple of years ago.
Yeah.
So, not a bad thought. Just again, it's going to be, different for each person. And then your second question, tell me that again.
I think Jason mentioned, or you also have to factor in your taxable accounts, right? It's for me, I don't factor those in until such time that I make a withdrawal. Am I doing that?
Yeah, and again, I want to make sure I
Not advice.
between taxable and make sure we're using the same we got the same definition for each account.
Bucket 3.
So when we say taxable, we're referring to like a brokerage account that is not a traditional IRA or not a Roth.
Correct.
Okay, so you are correct. If you do not sell anything in that account, so if there's no gain realized,
yeah,
you might not owe taxes on that gain. However, what typically will happen is that you'll have dividends pay or interest that pays. Sometimes if you hold mutual funds, there's going to be like year-end distributions that count as capital gains. So you might not have kind of a big tax hit because you're not selling anything, but depending on the size of the account, it might be generating. So just let's take an example. Let's say it's $100,000 and you just have it in a money market or CDs, they're paying 5%. Well, that's 5% in interest that's being kicked off. So that's $5,000. So again, it might not be a lot relative to your salary, but there could be something there.
Yeah. Okay. Thank you, sir.
Good questions. All right, we're going to move on to a different topic, almost completely, but it is relevant to having to minimize what you're paying the government, and that's going to be the Medicare premium surcharge. And so when you're 65, you can go on Medicare. And the scenario, I'm going to try to keep this as simple as possible, is we're going to talk, there's a lot of different parts that you pay when you go on Medicare. I'm not going to get into all of them. I'm going to focus on Part B. And depending on how much you make, depends on how much you pay. And it's based off of the most recent tax return. Your income is on that tax return, and that's typically 2 years ago of when you're going to be applying for Medicare. Therefore, it's going to be based on when you were working. And that's typically going to be in a higher tax bracket, in this case, they have their own brackets, as you can see, these income brackets. And so if you had earned 300 in this bracket right here, let's say $350,000 joint, you're going to be paying $454 per month per person. And so that can be thousands of dollars per year very quickly that they're not going to say, oh, you just retired, you don't have to pay. No, it's based on that tax return. But that retirement, if you were to retire and then go on Medicare, that life-changing event is considered work stoppage, and you can't appeal it using this form, SSA.44. Todd's going to include that in the chat. Let's say you don't plan on going to Medicare anytime soon, at least you have the form on file to access. Again, a lot of people don't know this. I've got clients who came to me and said they don't want to retire because of this this fee that they're going to be paying on Medicare. Go on Medicare because again, don't let that prevent you from making these to retire. By all means, there are ways to appeal it down to what your lower bracket is at the moment, and that's using this form. And again, we do this with clients. You fill this form out, you provide them with the material, that the supporting documentation, like a tax return, most recent pay stub or last pay stub, and that's typically all that they would need. So the steps go like this: you apply for Medicare, they give you a confirmation letter saying what that premium is. You appeal that at that time. Oops. Let me back up. Sorry. Anything to add though, Todd?
So ideally, we want to get everybody down to the 174.70. That's going to be the minimum that you pay for Medicare. So the idea is to appeal and get you down to 175 each. So that's going to be the minimum.
That's right. All right, I'm going to move on just with time's sake. We'll hand it over to Todd. He's going to talk a little bit about charitable donations.
Yeah, so many of you on the call here are probably charitably inclined. The main reason you're making donations to charity is because you believe in that organization. However, to pose a question here, are your charitable donations saving you taxes? Well, a lot of people think, well, that's a secondary benefit to that. The answer is probably not. And a lot of people don't realize that. They think instantly they make a donation, they're going to get a deduction. Well, is anybody familiar with the standard deduction versus itemizing? Those two terms. So the way it works, you take the higher of the two. You either take the standard deduction, which this year is $29,200, or you itemize. So if your itemized deductions are higher than the standard deduction, then you take the itemized. Common itemized deductions are charitable donations, mortgage interest, and medical expenses. There's others, but those are the three most common deductions. What'll happen is that, let's say you're making, I don't know, let's just say it's a $10,000 donations to various charities in 2024. And you think, okay, that's a pretty big donation, I'm going to deduct that. Well, let's say that your charities plus mortgage plus medical don't add up to more than $29,200. Well, in that case, you're getting the $29,200 regardless of whether you made that charitable donation. So you're not getting any tax benefit for it. Again, that's not the only reason to do it, but if if you're gonna do it, try to get the tax deduction. So what's the solution? So how do we get the tax deduction? Well, there's an instrument called donor advised fund. And I'd say it's kind of like setting up your own endowment. It's not, it usually doesn't cost anything to set up a donor advised fund. It's just another account at typically at a brokerage firm to set up. Very simple, just some paperwork. So what do? Let's say that your intent is over the next 5 years to contribute to charities $10,000 each year. So that's the goal. Now, if you do 10,000 each year, it's not going to give you any tax benefit, right? We already talked about it's not going to go above your standard deduction. Well, with a donor advised fund, you can front load it. So let's say you take all 5 years and you front load it 50,000 into the donor advised fund. Okay, with a donor advised fund, it acts as a charity. So you put it in there, and the year you put it in, you get that deduction. So you get that $50,000 that you can itemize. And again, the $29,200 is a standard deduction. So the $50,000 minus the $29,200 will be $20,800 above that standard deduction. So going back to our example of the 20% effective rate before, roughly what would that save us in taxes? So again, we're getting an extra deduction of about $20,800. We're in the 20% bracket. What's that going to save us? Anyone?
I see Jason's on the calculator there.
Yeah. So we're going to take about 20,800 times 20%, just to give you a hint. So, so it's about $4,000, right? So again, it's serious money. If you can fund it all up front. Now with the donor advised fund, you get the deduction in this year, but you're not forced to contribute to those charities all at once. So you could donate to those charities over the next 3, 4, 5, 10 years, however you want to do it. Most people don't want to give that, give a large amount all in 1 year to a charity, but this is a great way to get the tax deduction and then give to those charities over time. The donor advised funds typically have like a bill pay and you just send it to that charity.
So can I throw something out there? And
Sure.
this is a hypothetical. This isn't my life. If I'm paying about 30,000 in taxes every year, and most of that is coming because of my taxable account that I've saved up, I could be putting this money into a donor advised fund, reducing that 30,000 that I've been paying every year, and kind of get ahead of it instead of what I feel like being behind it all the time.
Well, now again, that maybe I want to make sure I'm clear is once that money goes in there, it has to go to a charity.
Sure, that's fine. That's great, actually. I'm glad.
Yeah. So it's kind of out of your control. It can go to a charity. So yes.
Yep.
So
I'd rather go to charity than the government.
Right. So if it's 30,000 and you're whatever number you're putting 30,000 in, that 30,000 is gone, and you're getting a deduction of, let's say it's 20% on that. So you're saving yourself 6,000, but you're still putting 30 into charity. As long as you're comfortable doing it,
Yeah.
that donor advised fund is an avenue to look at.
Okay, great. Thank you. That was worth everything already.
And Britton, is there something wrong with the slides? I'm just so you know, I'm seeing like.
Oh gosh, sorry. I thought you had the hold on.
Yeah, I don't know if the presentation mode's still up there, but.
Oh, I see what you're saying. Yeah, let me do this. Slide it back. There we go.
So that's anything else on the donor advised funds? Good questions, good examples there. Okay, you want to talk about, I think, tax loss harvesting. I think that's the last sort of.
Yeah, we're gonna bring in for a landing here. So harvest tax losses, you may have heard of it. Like, why would you do it? When would you do it? And one of the things that to keep in mind is this is looping back that taxable account. For example, if you have positions it could be stock positions, bond positions, doesn't matter, that are in a loss. We did a lot of this in 2022 because the market was going down for clients. There's really no right or wrong time to do it, except for like when you see, let's say it's position's down $10,000. Well, we would sell that position, realize that loss for that $10,000 for the client, and then buy a similar position alongside it. So we stay invested, and we're harvesting that loss. And so the client takes that $10,000 loss, and when they file the taxes, they may offset some gains. If it doesn't, it may offset up to $3,000 of ordinary income. So if they don't have anything to offset, then they can carry it forward. And so it's tax savings for now and later. And if you were to pick a season to do it in the third quarter, we do a lot of tax projections for clients, and seeing where the income's landing for the year and what strategies are there. Is there any opportunities, any positions to sell that would offset those losses, or those gains rather, the income for that year? And so, like, again, that's in a nutshell what is how we would do it for clients when it comes to harvesting tax losses.
Yeah, and just to put some dollars on that, in the $10,000 example, like we mentioned, if you're, on these gains, you're either going to be paying 15 or 20%. If you're working, you're probably not going to be paying 0%. So $10,000 in tax harvesting losses, that might save you $1,500 in taxes to $2,000 in taxes in the future. So again, the bigger those losses are and the bigger the gains are, those taxes are gonna add up. So as you can tell, the theme is that, you have these small things that you can do for tax savings, for tax planning, but if you combine them, you do them over time, the tax savings start to add up to even more.
Yeah. All right, and just to kind of end it, just to keep in mind that we're focusing on the tax planning piece here. It's that time of the year; it's on everyone's mind. You're doing it. You're filing your taxes, but there are other areas that we've talked about that impact you financially. We talked about the investment positioning. We didn't talk about cash flow management, but it's definitely impacted by what you're doing in the tax planning. So if you're going to save yourself on taxes, it's going to save you in income. And so the point is, coordination is key with who's in your life. Right now, we're talking about, we're financial advisors, but they're also the accountants in your life. And the communication between those two parties is critical for the success. And a lot of times you'll have people working in your life doing things for you in these areas that are working in silos and not communicating. That's where mistakes can be made. And so it's important to have that coordination. And that's kind of our approach when it comes to financial planning. So like I mentioned in the beginning, we're going to send you out a link to the recording, as well as the financial calendar. A link to that's in the chat, I think, right now, Todd, as well as a link to our contact if you'd like to set up a call one-on-one. We can go over some specific questions that you have.
Yeah.
Okay.
Any other questions? We went over a lot today, so it's a lot to take in.
Well, appreciate the information today. It was an awesome 60 minutes, so thank you for that.
Great. Yeah, we appreciate the questions, participation. That always helps. I think everybody on the call, learns from each other as well.
Yeah.
So last question. So why are advisor fees so high? And that's from a person that's a position of ignorance with the industry. You just look at the 1% or 1.5% or whatever it is. It seems high to pay that fee on an annual cycle, right? That could be a big chunk of your portfolio. And then how do you compete with the growing kind of robo investor space that's doing something similar without the personal interaction? Are those fair questions to ask?
Sure.
Okay.
And I apologize, my power just went out of my house somehow, so that's why my video just went out, but
Rainstorm.
you can hear me?
I think you got it charged up, Todd.
So I think the question is, just the fee and like, to say it again, Gary, sorry, I was a little
Yeah, no, the fee, when I read a lot of reviews from the kind of the wealth management space, the common theme is, boy, these fees are really high. It's eating away at my portfolio. And I have to pay every year 30,000, 40,000, whatever the number is. And then we get a lot of these queries nowadays. Hey, we're a robo investor company and we can invest your portfolio and we based on market trends and those sorts of things. How do you compete with that market?
Oh,
Yeah.
sure. Go ahead, Todd.
Yeah, I mean, that's a good question. How do I say it? I mean, there's a lot of people out there that can and want to do the investments themselves, the financial planning themselves, and that's okay. Like that's fine. Some people have that interest, they have that knowledge base, or they want to learn about that. And for those people, maybe doing it themselves is right because they can save themselves some money, right? But we have noticed, especially as people are approaching retirement, things get more complex. We often see that, mistakes can be made and the stakes are higher when you're approaching retirement. And, I've seen many times, especially on the investment front, where you can easily make a 1% mistake and it takes you 10 years to get caught back up. So, I'll give a quick example of this. I don't know why this hit me, but I remember when I was a kid, my dad loved working on the cars and doing everything kind of his own to save us money, right? And he was pretty handy to change the oil and, fix a flat and all that stuff. And it got to one point where it was the water pump that went bad. And I'll never forget, he was in the driveway and I could tell it was just taking him like a really long time, more so than you'd think. And, obviously back then you didn't have YouTube videos. And, and he came in and you could just tell the look at the feet on his face. And he's like, I can't get it back together. Like I took it apart, I couldn't get it back together. And he got to call a tow truck and, bring it in and all that. Right. And and he had to pay something. Right. But probably would have been better off. He was in over his head in the beginning. And he probably would have been better off just paying someone to do it. So again, I'm not saying you can't do this on your own. Just saying kind of know your expertise and, that's the main thing. Know your expertise and just, be comfortable with it because this is your life savings and, this has to last for the rest of your life. So we take that, very seriously. And so that's I just say to reflect on that. Again, it's not for everybody, to do it themselves.
Thanks, appreciate it. Yeah.
That's a good question. Was there something, was there a secondary question to that you had that I missed?
Yeah, don't worry about the other question there, my friend. Appreciate it.
Okay.
I think you also get what you pay for. So I wouldn't compare us with a robo advisor. You're definitely paying too much if you're paying 1% on just the investments. That's going to be, maybe the half of that worth for the money management side. And there are plenty of firms that just charge for doing the investments. And so we're doing the comprehensive planning, everything. We can't do that, the investments without knowing like how much you need to live on and, being aligned with your lifestyle. And so it does take a lot of work. And we talked about the taxes today. So we gave you some examples of ROI from what that fee would be.
Yeah, those are all good questions. What else? Okay, well, we're a little bit after 1, so just in the respect to everyone's time, we did put our link in the chat. There's also the link to the financial calendar if you have not received that yet. And yeah, I think that's it for today, unless there's any other questions.
Everybody, thanks a lot for stopping by. We'll be doing this likely every quarter, so look out for that information in the future. Your email.
Look forward to it. Thanks, guys.
Take care. Take care, everyone.
Thanks, guys. Appreciate it.
You're welcome.
Happy to help.